Believe your bank's transparent with you. Time for a reality check. Today, we're diving deep into banking secrets that might surprise you. Welcome to Money Craft Masters. In 2019, 94 of U.S. households had a bank account. With such a vast majority relying on banks, it's essential to understand the hidden intricacies of their operations. Prepare to have the veil lifted as we delve into the banking industry's best-kept secrets. Given the central role banks play in our daily lives, it's crucial to understand how they work to make wise financial decisions, but banks don't always play by the rules. Sometimes they have secret policies that you should be aware of. Without further ado, let's dive in and discover some of the banking industry's best-kept financial secrets. You're wondering what they are. The first secret is the right of offset. Banks have a feature called the right of compensation, also called set-off, which allows them to take money out of one of your accounts to pay off a debt from another account as long as the same organization holds both versions. This feature guarantees that banks can collect unpaid debts from clients using their funds on deposit with the bank. For example, let's say you have a car loan and a checking account with the same bank. If you don't remember to make the car loan payment, the bank can automatically deduct the required amount from your checking account to cover the loan payment without requiring further action. This way, the bank can guarantee that your loan remains current without you having to take any action. Secret number 2. Banks are open to negotiation like many other industries. The banking sector is competitive, which can work to your advantage. It's easy to think of banks as rigid institutions, but in reality, they are keen on retaining their customers. When you initiate a relationship with a bank, such as opening a new account, you usually sign an agreement that dictates the terms of use for that account. The rights of offset provision is often included in this agreement. However, how this provision is described might differ from one bank to another. This readiness results from the fierce rivalry they encounter with other financial organizations. If you come across an overt draft cost, be aware that you can usually dispute these charges. Banks are generally willing to discuss fees and may even reverse them to keep their clients happy. This strategy isn't just for banks. Credit card companies also work similarly. For example, if you've missed a monthly payment, you can ask for a one-time late fee waiver. Additionally, because banking is so competitive, mentioning that you might think about switching to a different institution can occasionally give you an advantage in negotiations. For example, if you're hit with multiple overdue fees or aren't happy with the terms, mentioning that you might consider taking your business elsewhere could prompt the bank to be more accommodating. Beyond costs, there is room for negotiation on credit card annual percentage rates. If you think you're paying too much interest, contact your provider to work out a better deal. After all, financial institutions want to keep their clients happy and committed. Third secret. You might be held accountable for deceptive transactions. Even with safeguards, fraudulent transactions, also known as unauthorized charges on your credit card, seriously threaten your financial health. As per federal law, if your card is lost or stolen and you report it immediately, you are usually not held accountable for any charges made without your consent. The timing of your report determines how much you might owe. If you notify the bank within 2 business days of losing your card, you may be liable for up to $50 in unauthorized charges. If you delay this report and only notify your bank about the loss between 2 and 60 days after receiving your statement, your liability might soar to $500, so it's imperative to keep a close eye on your account. Ideally, it would be best if you did this daily. If you discover any unauthorized charges or lose your card, notify your bank or credit card company immediately. This will reduce potential financial losses and help the bank take prompt action, including blocking the card or investigating questionable activity. Fourth secret number. Since credit unions are not-for-profit, they put the needs of their members first. Any profits they make are usually reinvested in the organization or returned to members in the form of lower fees, lower interest rates, or other benefits. As a result, credit unions may offer better loan rates than traditional banks, which prioritize profits for shareholders. You have a direct say in the union's choices and reap the benefits of its profitability as a member, making you more than just a consumer. One of the main benefits of doing business with a credit union is that they can offer better lending rates with generally lower overhead. Credit unions can provide reduced interest rates on various financial products, including credit cards, mortgages, and loans. In essence, you might spend less in costs over time than if you took out a loan from a traditional bank. This saves you money that you can use for investments, trips, or other pursuits. In addition, credit unions may charge lower account fees, attracting many customers. Despite these advantages, people should still be diligent when applying for a loan, mortgage, or other financial product. It's a good idea to check offers from several lenders to ensure you get the best price. The fifth secret is that you can choose not to use overdraft protection. To prevent declined transactions and ensure the continuity of your payments and purchases, overdraft protection is a banking feature that permits transactions, whether debit card purchases or automatic payments, even if there are insufficient funds in your account. However, overdraft protection does have a cost. Banks could tax avoid unexpected overdrafts and the associated fees by avoiding high prices, which can sometimes reach up to $35 each time they cover an overdraft for you. These fees are not one-time. If you make multiple transactions that exceed your account balance in a single day, you may be assessed numerous payments that quickly add up. You should keep a close eye on your bank account and set up text or email alerts with your bank to receive real-time notifications whenever your balance is low. This will allow you to transfer funds or postpone transactions that could result in overdraft. Additionally, several well-known banks, including Capital One and Bank of America, announced last year that they plan to reduce or eliminate these fees to ensure more customer-friendly practices. Secret number 7, deposits aren't always available right away. One might assume the funds become instantly available when depositing money into a bank or credit union. However, this isn't always true. In reality, each financial institution has its own rules regarding the time it takes for a deposit to clear and the funds to become accessible. Federal law states that banks must make deposited funds available within a reasonable time. This time frame can take up to 2 days or even longer for deposits over $5,000 or those made at third-party banks or ATMs. Furthermore, the banking industry has seen a significant transformation due to the rise of digital banking and the use of mobile apps for financial transactions. These technological advancements have resulted in variations in the time it takes for deposited funds to become available, even though mobile app deposits offer convenience and may take longer to process than traditional methods like in-branch deposits or ATMs. Users, particularly those who use digital and traditional banking methods, may become confused by this inconsistency. Therefore, if you use multiple methods to deposit funds, you must become familiar with your bank's deposit policies. By understanding these timelines, you can manage your finances more effectively and prevent unintentional check bounces and overdraft fees from arising from assuming funds are available when they aren't. Early loan repayment could cost you extra. Although paying off debt early can feel like a smart financial move since it can provide financial independence and relief, there are better courses of action. For example, paying off credit card balances early can have a favorable influence on your credit. Concerning other loan kinds, such as auto or personal loans, there may be disadvantages to consider. The reason why lenders typically impose an early payment fee, which is essentially a penalty for returning the loan earlier than scheduled, is apparent. Lenders anticipate earning interest during the loan. If they get payment early, they forfeit that expectation. Your credit score is another factor to consider, in addition to possible fees. Your payment history accounts for a large amount of your FICO score, 35% to be exact, and shows how consistently and steadily you have been able to pay off your loans. It establishes a track record that you are reliable in handling debts, but if you choose to pay back a loan early, this continuous record is shortened. Rather than having a 5-year history of on-time payments, you may only have 2 or 3 years if you pay off early. Although early settlement can seem like a wise financial decision, in many ways, it may limit future credit score improvements. Thank you for joining us on this enlightening journey through the banking industry's best-kept secrets on Moneycraft Masters. From the right of offset to the intricacies of early loan repayments, It's evident that the financial world is filled with nuances that can impact our daily financial decisions. As consumers, we must be informed and vigilant, ensuring we're not caught off guard by hidden policies or practices. Remember, knowledge is power, and understanding these banking secrets empowers us to make smarter financial choices. Stay tuned for more insights and tips to master your money craft. Remember to like, share, and subscribe for more financial revelations.